What is the anatomy of a proper trading strategy? If you ask 100 traders what their strategy is, 99% of them would just talk about their entry signal, right? Oh, I go off of an IFVG or some kind of order flow topic or something like that. But the entry signal is just a piece of a proper trading strategy, and it's what makes the 97% of traders lose is because they just focus on their entry signal, when the rest of your strategy is arguably more important than just your entry signal is. So your entry signal is overrated. So two traders can take the exact same entry and one can win and one can lose, and this is because of what they do after the entry. Your entry dictates when you are in the trade. The other four parts dictate how much you win when you're right and how little you lose when you're wrong, which is the real game that you need to be playing when you're trading. So your edge or your entry. So this is the repeatable condition. This is where the odds are tipped in your favor. For discretionary trading, this is a pattern, a level, order flow condition. It's what signals that you should be in a trade right now. For an algo trader, this is a mechanical condition or a signal identified by your machine learning algorithm. The key here is that the edge is a statistical tilt. It's not a prediction. Over a large enough sample size, your signal is correct more times than it's wrong. A common mistake here is mistaking a random win or just a small set of wins as edge when you're just getting lucky and the variance is your edge in that play. So your edge needs to be measurable over repeatable large sample size of trades, not just, a 10 trade win streak. That doesn't mean that you have edge, that just means that you had favorable variance. So now we move on to the exit. So there's two types of exits and both matter. The exit when you're wrong, which is your stop loss, and the exit when you're right, which is your take profit. And both of those matter massively because they determine your risk to reward. Then when we combine your risk to reward with your win rate, then we can derive the expectancy, positive or negative, of your strategy, and then that determines your edge. The entry doesn't determine this, the exit does. The problem with an exit is it actively fights your normal psychology. People are inclined to cut their winners short because they're in profit, they're scared of it reversing and hitting their stop loss, and then they cut their losers late because they don't want to be wrong. And both of these actions actively destroy your expectancy, right? I think we've all done that. You've been in a losing trade and you held it way longer than you should have because you were scared to be wrong and you're scared to lose and you were hoping that it would reverse. Or you cut your trade short before it hit take profit and then it ran up and immediately hit where you would have had your take profit because you were scared of it reversing and coming back down to your stop loss. And you need to have these as structured levels because you need to be able to have a proper risk to reward with your win rate to actually extract positive expectancy from your strategy. Now on to risk and position sizing. So this is how much size you use in each trade, right? If you're trading NQ, do you trade one mini? Do you trade 5 micros? Something like that. And it decides if you have enough runway to realize your edge, because you can have positive edge and expectancy, but if a losing streak can liquidate your account, then you won't be able to realize your edge because the variance at some point will hand you both winning streaks and losing streaks, and you will go on a run of long losers. And if that run of long losers is enough to fully blow your account, then you do not have proper sizing and proper risk. But this changes specifically for people trading prop firms because of the convex payout structure, because a 50K account, let's say, costs $90, but the payoff is 2,000 if you take it all the way to max payout once, but you can take it to max payout, up to 5 times, so let's say $10,000. You can use significantly more risk because your strategy is only risking $90, really. It's not risking $2,000, which would be your total drawdown. Now we move on to regime filtering. So this is the part of strategy that almost nobody has actually quantified, and it takes a long time to build up the discretion to know when not to trade. Because every edge is conditional. A continuations model will fail in a mean reverting regime, and a mean reverting strategy will fail in a strong trend, let's say. And this is the biggest part for discretionary trading because the entry, exits, and sizing can all be hard snap conditions, right? I enter on this one thing, I exit at this level, and I only bet 5 micros on it, right? That's super easy to quantify and tell yourself, but actually knowing when the regime is mean reverting, when the regime is trending, that is where you can derive a big piece of your edge as a discretionary trader. As an algo trader, these things can be quantified using indicators like ADX or an ADR, among lots of other indicators. But you need to test those and make sure that you don't curve fit them into your strategy. But for most discretionary traders, they just identify when they're in favorable versus unfavorable conditions. But doing nothing in regimes that don't suit your strategy is an active skilled decision that a lot of people miss out on. And it is where a lot of discretionary edge can be derived from, is simply just knowing when you shouldn't be trading and when this is a bad regime, and when we're in a good regime, just risking up or using a different amount of risk when we're in a favorable regime. And then finally, we have reviewing your data. So you need to be logging your trades, because if you're trading blind, how do you expect to be successful? This can be journaling your trades and or just looking at your account metrics. You need to find parts of your strategy that are helping you and parts that are hurting you. And it needs to be a large enough sample size to hold statistical importance. This doesn't mean you had one bad day and you change your confluences. It's you've lost, 50 of the last 70 mean reversions on Thursdays. You should probably not take mean reversions on Thursdays. But you need to know if your strategy has decayed or if you're just on a normal losing streak. And you need data to be able to determine that. And you need to be honest with yourself and not try to inflate your numbers to make yourself feel better, because the only person you're hurting when you're doing that is yourself. And I would say that this is actually the most important, because your edge will decay over time, right? A strategy that people traded 5 years ago likely isn't a viable strategy in today's market. So you need to be able to review your data and adapt to market regimes and market conditions as they change. So how do all these fit together? So I like to think of it like a car. So your entry is the ignition and the engine. It's what starts the car and allows it to drive. But an ignition and an engine without any brakes, without a fuel gauge, and without knowing when the road is too icy to drive on is destined to fail, and you will end up in a crash, right? Just because you know to enter on whatever confluence you have, but you target way too high, or you target way too low, or you don't use enough stop loss, you use too much stop loss, etc., that can take a winning strategy and turn it into a losing strategy. So you need to be able to have all of these aligned together so that you can make a proper winning strategy. So to finish out our video here, I would say next time that you lose a trade and then you decide, it's time for a new confluence, it's time to change up my entry, you should look at your strategy as a whole and decide if the entry is the actual problem. Because the problem can occur in all 5 parts of your strategy, or just in one part, or all 5 parts are flawed, maybe 3 parts are flawed. And maybe you need to update your exits. Maybe you need to risk less. Maybe you're on a statistical losing streak, because that will happen just with normal variance. At some point, you will go on a streak of losers, because changing your entry confluence changes everything. And you need to recollect your data and you need to update all your other 4 parts, because the entry isn't always your problem. And when you change your entry, that makes all the other parts of your strategy now different, and you have totally changed your edge, and you don't know if that strategy has edge anymore. But that fairly well wraps it up. If you have any questions, leave them in the comments. I'll leave a link to my Discord, my free Discord, and you can join that and see what you think. Ask any questions in there. I'm always in there helping people out, whatever you need. And yeah, that wraps it up. I appreciate y'all.